California's real estate dream is crumbling, and no one's talking about it. In cities once selling homes at $900,000, prices are now slashed by $120,000 or more. Inventory is surging 70%, while foreclosures have tripled in towns like Stockton and Bakersfield. Across the Golden State, properties that sold in 8 days now sit abandoned for 75+ days, drowning in price cuts. Families are fleeing. Flippers are losing their shirts. This isn't a dip. It's a full-blown collapse in slow motion. These 10 California cities are ground zero for a devastating crash that could erase billions in equity. And it's already begun.
Number 10. San Francisco. San Francisco, once the crown jewel of California real estate, is now grappling with one of the most dramatic housing reversals in its history. The city that once drew global wealth, tech titans, and investors willing to pay any price for a piece of its iconic skyline is now facing a sobering correction. At the peak of the 2021-2022 frenzy, median home prices in San Francisco soared to a staggering $1.65 million, fueled by stock market highs, IPO cash-outs, and historically low interest rates. But by mid-2025, that figure has slipped to $1.49 million, a 9.7% drop, wiping out over $160,000 in equity in just 2 years. Inventory tells an even more alarming story. Active listings have surged 88% year-over-year, from around 880 homes on the market to more than 1,650 today. Days on market have more than tripled, from an average of just 14 days during the pandemic peak to 46 days now, signaling a clear slowdown in buyer urgency. High-earning professionals who once paid extra to be close to the office are now buying in distant suburbs, smaller cities, or even out of state. Affordability is collapsing. With a 7% interest rate, the monthly mortgage payment on a median-priced home is over $9,000, more than $108,000 annually before taxes, insurance, and maintenance. Even households with the city's $136,000 median income are finding ownership increasingly unattainable. Redfin reports that 36% of active listings saw price cuts in Q2 2025, with reductions averaging $94,000. If current trends hold, analysts warn San Francisco could see another 8 to 12% price decline by mid-2026, pushing many late-cycle buyers into negative equity. For a city that once seemed untouchable, this is a stark reminder. Even the most prestigious markets can fall hard.
Number 9. Orange County. Orange County was once seen as the crown jewel of California's real estate, a place where ocean views, pristine suburbs, and affluence created an almost invincible housing market. But in 2025, even OC's luxury isn't safe. The median home price here peaked at $1.16 million in 2022. Fast forward to mid-2025, and that number has slipped to $1.03 million, a drop of over $130,000 or 11.2%. And the pain is just beginning. Inventory tells the real story. At the start of 2025, Orange County had 2,594 active listings. By mid-year, that figure has surged to 5,121, nearly doubling in just 6 months. That's a 97% increase in supply in one of California's most desirable markets. Meanwhile, buyer demand has collapsed. Pending sales are down 29.4% year-over-year, and days on market have ballooned from 14 days in 2021 to 43 days in Q2 2025. Higher interest rates are crushing the high-end buyers who once drove OC's bidding wars. At a 7% mortgage rate, monthly payments on a $1 million home with 20% down now exceed $6,200, pricing out even upper-middle-class families. The result? price reductions everywhere. Redfin reports that over 39% of homes listed in OC had at least one price cut this spring. Luxury neighborhoods like Laguna Niguel, San Clemente, and Mission Viejo are seeing steep pullbacks. In Laguna Beach, properties once listed at $3.2 million are now relisted at $2.75 million with no offers in sight. Sellers are panicking. The real estate agents who were once gatekeepers of exclusive homes are now staging open houses every weekend, often to empty rooms. Orange County is learning the hard way that even luxury markets can't defy gravity forever. The correction has begun, and it's heading for the high-end homes first.
Number 8. Modesto. Modesto, in California's Central Valley, was once the pandemic-era escape hatch for Bay Area buyers priced out of coastal cities. With larger homes, sprawling yards, and a median price well below the state average, it became a hotbed for remote workers and investors between 2020 and 2022. At its peak, the median home price hit $485,000, a record high for the city. But in 2025, that narrative has flipped. Median prices have fallen to $421,000, a $64,000 drop in less than 2 years, and signs point to more declines ahead. The biggest problem? The affordability gap between Modesto and nearby coastal metros has narrowed, while high mortgage rates have erased much of the value proposition that once drew buyers here. Inventory has exploded 58% year over year, with active listings climbing from 560 in mid-2024 to nearly 885 today. Homes that sold in under 10 days during the boom are now sitting for an average of 52 days, and bidding wars have all but disappeared. Price cuts are everywhere. In June 2025 alone, 39% of listings reduced their asking price, often by $25,000 to $50,000 within the first month. Foreclosures are quietly creeping back, now at 1 per 1,300 housing units, with many tied to buyers from the 2021 peak who purchased with low down payments. Investors are pulling back. Rental demand is softened, and several new construction projects have been delayed or canceled entirely. For those who bought in Modesto at the height of the frenzy, the path back to break-even could take years. The once affordable alternative to the Bay Area is now one of California's most vulnerable housing markets heading into 2026.
Number 7. Sacramento. Sacramento, California's state capital, was once hailed as the affordable escape from the Bay Area's crushing home prices. During the pandemic boom, buyers swarmed in from San Francisco, Oakland, and San Jose, snapping up homes in bidding wars that pushed median prices to an unprecedented $570,000 in mid-2022. But by mid-2025, the capital's market is bleeding value. Median home prices have fallen to $505,000, a $65,000 drop, and industry analysts warned the decline could deepen another 8 to 12% by next summer. Why? Because Sacramento's population growth, the very fuel for its housing boom, has slowed to a crawl. Migration from the Bay Area has plunged 42% compared to 2021 levels, while outbound moves from Sacramento to cheaper states like Idaho, Texas, and Arizona have surged. Inventory is flooding the market. Active listings are up 78% year over year, with more than 3,200 homes now for sale compared to just 1,800 a year ago. Days on market have climbed from 12 during the frenzy to 46 today. More than 37% of current listings have had at least one price cut, with some seeing 3 consecutive reductions in 60 days. Adding to the pressure is Sacramento's affordability gap. At today's interest rates, a median-priced home comes with a $3,700 monthly mortgage, far beyond reach for the city's median household income of $83,000. Neighborhoods that saw rapid gentrification in 2020-2022 are now dotted with for sale signs, and suburban developments in Elk Grove and Roseville are offering $20,000 to $30,000 buyer incentives just to get contracts signed. Sacramento's housing market is not collapsing as dramatically as smaller cities yet, but the cracks are spreading,
And with supply climbing and demand evaporating, the capital's days as a safe bet are over.
Number 6. Laguna Niguel. Laguna Niguel, perched on the stunning coastline of southern Orange County, has long been one of California's most coveted addresses. In 2022, median home prices here hit $1.4 million, fueled by a relentless mix of wealthy buyers, limited inventory, and the kind of ocean-kissed lifestyle people will pay anything to have. But even this slice of paradise is not immune. By mid-2025, prices have slipped to $1.26 million, a 10% drop, and luxury agents admit privately that the market has fundamentally shifted. Inventory has ballooned 92% year-over-year, with more than 330 active listings in a city that typically has fewer than 180. High-end homes are sitting on the market for months. In the last quarter, average days on market for Laguna Niguel hit 61 days, compared to just 15 during the 2021 peak. More than 42% of listings have seen price cuts, with reductions averaging $85,000. The culprit? Affordability at the top end has collapsed. Even wealthy buyers are balking at mortgage payments exceeding $9,000 a month for a median home, plus property taxes and insurance. And the out-of-state luxury buyers who once propped up prices are disappearing, deterred by California's tax climate and rising insurance premiums along the coast. Developers who built luxury spec homes in 2022-2023 are now unloading them at a loss. Meanwhile, flippers who expected seven-figure profits are finding their listings sit stagnant, despite staging, marketing blitzes, and deep price cuts. Laguna Niguel's fall won't be as steep as working-class markets, but make no mistake, the days of effortless appreciation here are over. For the first time in decades, even the ultra-wealthy are thinking twice before signing in this coastal enclave.
Number 5. Santa Clarita. Santa Clarita, tucked in the hills north of Los Angeles, exploded in popularity during the pandemic as families sought larger homes, good schools, and a quieter suburban life. By late 2021, median home prices reached $810,000, an astonishing figure for a market once considered a bargain compared to LA. But the 2025 market tells a very different story. Prices have slipped to $728,000, an $82,000 drop, and sellers are struggling to find buyers. Inventory has surged 88% year-over-year, and homes that sold in 2 weeks during the boom now sit for an average of 54 days. Santa Clarita's problem is twofold: rising mortgage rates and soaring property taxes. At 7% interest, a median-priced home comes with a $4,900 monthly mortgage. Factor in taxes and insurance, and buyers face $6,000 plus in housing costs each month, far above what the area's median household income can sustain. Price cuts are rampant. Nearly 44% of active listings in Santa Clarita have been reduced, with average cuts topping $60,000. Even new construction communities in Valencia are offering free upgrades and $15,000 toward closing costs. And then there's competition from other markets. Many would-be Santa Clarita buyers are skipping LA County entirely, opting for cheaper, newer homes in the Inland Empire, or even moving to neighboring states. The result? A sharp drop in demand, leaving sellers chasing a shrinking pool of qualified buyers. Santa Clarita isn't in free fall yet, but its rapid cooling shows how quickly safe suburban bets can lose steam when the math no longer works for middle and upper middle class families.
Number 4. Bakersfield. Bakersfield was one of California's last bastions of affordability, and during the pandemic, it became a magnet for buyers priced out of coastal cities. Median prices jumped from $255,000 in 2019 to $385,000 by early 2022, a 51% surge in just 3 years. But in 2025, the party's over. Prices have slipped to $344,000, a $41,000 loss, and foreclosures are rising sharply. In Q2 2025, Bakersfield recorded one foreclosure per 980 homes, the highest rate in the state.
Inventory has climbed 77% year over year, with nearly 2,000 homes now on the market. Days on market have doubled from 20 to 42 days, and 38% of listings have seen price reductions averaging $25,000. Bakersfield's economy is heavily tied to agriculture and oil, both sectors facing uncertainty. Job growth is stalled, wages remain low, and inflation has eaten into disposable income. For many buyers here, even a modest mortgage has become unmanageable. Investors who once bought up Bakersfield homes in bulk for rentals are now offloading properties. With rents falling 6% in the past year, the math simply doesn't work. Neighborhoods that saw rapid construction in 2020-2022 now have multiple for sale signs on each block. Bakersfield may not have million-dollar homes to lose, but percentage-wise, its decline is brutal. And the wave of distressed sales just beginning could push values down another 10 to 15% in the coming year.
Number 3. San Diego. San Diego's housing market has long been insulated by its coastal charm, strong job market, and military presence. But in 2025, even this jewel of Southern California is showing cracks. Median prices have fallen from $930,000 in 2022 to $848,000 today, an $82,000 decline. Inventory is up 69% year over year, with 5,400 active listings compared to just 3,200 last summer. Days on market have stretched from 11 to 39. High mortgage rates have hit hard. At 7%, a median-priced San Diego home requires a $5,600 monthly mortgage payment, far out of reach for the city's $101,000 median household income. The affordability gap is the widest it's been in decades. The slowdown is most visible in once white-hot neighborhoods like North Park, La Jolla, and Carmel Valley. Price cuts of $100,000 are becoming common, and luxury condos downtown are offering months of free HOA fees to attract buyers. Tourism, a key driver of the local economy, has softened post-pandemic, and military housing demand hasn't offset the broader market cooling. Investors who once relied on short-term rentals are facing stricter regulations and lower occupancy, leading to forced sales. San Diego isn't headed for a catastrophic crash, but the days of double-digit annual price growth are over. In fact, analysts predict prices could stagnate or decline slightly for the next 3 to 5 years, erasing the city's once bulletproof image.
Number 2. Stockton. Stockton's pandemic boom was one of the most extreme in the state. Between 2019 and 2022, median prices soared from $320,000 to $505,000, a staggering 58% increase. But in 2025, Stockton is a cautionary tale. Prices have plunged to $435,000, a $70,000 drop, and foreclosures are spiking. The city recorded one foreclosure per 900 homes in Q2 2025, up 118% from last year. Inventory has surged 85%, with more than 1,400 homes now for sale. Days on market have jumped from 15 to 52, and 46% of listings have price cuts averaging $30,000. Stockton's appeal during the boom was its relative affordability for Bay Area commuters. But with remote work fading and gas prices hovering near $6, long commutes are a deal-breaker again. Job growth in the region has stalled, and crime rates remain a persistent concern. Investors are retreating, and neighborhoods that saw rapid appreciation are now seeing equally rapid depreciation. If prices fall another 10%, which is possible given the current supply glut, many 2021-2022 buyers will be underwater.
Number 1. Los Angeles. Los Angeles is the crown jewel of California real estate and also its biggest bubble risk. The median home price peaked at $915,000 in 2022. Today, it's $810,000, a $105,000 drop, and the correction is far from over. Inventory is up 74% year over year, with more than 14,000 active listings across LA County. Days on market have nearly tripled, from 13 to 37, and 41% of listings have price cuts averaging $50,000. High-end markets like Beverly Hills, Santa Monica, and Malibu are seeing properties linger for months. Even multi-million-dollar estates are sitting unsold despite deep discounts. Meanwhile, working-class neighborhoods face rising foreclosures as mortgage payments and property taxes overwhelm households. At 7% interest, a median-priced LA home requires a $5,400 monthly mortgage, unaffordable for the city's $83,000 median household income. The gap between income and housing cost is among the worst in the nation. LA's problem is structural. With declining population, increasing regulation, and an exodus of businesses, demand is unlikely to rebound quickly. Investors are moving capital to other states, and the city's once unshakable real estate brand is losing luster. If prices drop another 10%, as some analysts predict, Los Angeles could see the largest absolute loss of home equity in California history. The message is clear. California's real estate landscape is shifting dramatically. Stay informed, stay vigilant. Its beaches still call, its skies are still blue, but beneath the sunshine, the cracks are showing, especially in the housing market. From Los Angeles to Sacramento, from once booming suburbs to iconic cities, buyers are waking up to a new reality. The same homes that soared in price just 2 years ago are now sinking. This isn't just a slowdown, it's a reckoning. Overbuilding, inflated pricing, sky-high insurance, and shaky rental returns have left many Californians and hopeful newcomers holding the bag. And in some cities, that bag is full of falling equity and rising regret. The American dream didn't disappear here, but it did get distorted. So if you're looking to buy in California, be cautious, be informed, be strategic. Not every palm tree hides a paradise. Some are planted in markets that won't recover for years. Don't forget to like this video, share it with anyone who needs to see this vital information, and of course, hit that subscribe button for more in-depth analyses from Discover the Nation. We'll see you in the next video, because sometimes knowing where not to buy can be the best investment decision of all.